All right, well, good morning, everybody. I'd like to welcome you to our ongoing In the Trenches series. Today, I'm joined by a couple of familiar voices with whom you'll likely be familiar. Craig Nazzaro, who participates in almost all of these, is joining us today, part of the financial regulatory team here at Nelson Mullins. And also today, we're joined by Brennan Ryan, now that he is transitioning back into Nelson Mullins after a stint in the executive leadership team of a large bank in the Midwest. And so we're welcoming him. We have a great topic today. Today, we're going to be talking about bank and fintech partnerships and ways chartered financial institutions can think about employing fintech, bringing it not only into the chartered institution's own system and networks, but also as fintech becomes more predominant in the financial services sector, how can a bank, credit union, or other financial institution think about partnering with those fintechs to drive their own growth along with the fintechs? Yeah, as we talk today, we're really going to go through this kind of concept of the shift from traditional financial services over to a fintech online driven mechanism, ways that customers are now interacting with financial institutions. And we've got some quotes there just for your reference. But if you think about really what we're talking about here, is that when you say what are the largest financial players in the United States, you obviously think of some of the very large banks, that have dominated historically in the financial services sector. But more and more, you're thinking about non-bank technology-driven entities, whether that be PayPal, Venmo, Apple Pay, Lending Club on the lending side, others that are really changing the way that business owners or consumers are interacting with their financial services providers. And the way that has expanded has been dramatic in the last 10 years, where originally fintechs were providing a way to bring technology to traditional banking services. Now, fintech has taken the lead on the way you actually develop the services. We've seen the rise of things like full digital account opening, where an individual never goes into an institution anymore. The shift to extremely full service digital and mobile banking, where everything is now handled from your cellular device, so that you're not actually interacting with bankers or service providers anymore. You now see full service ATMs that can cash checks, dispense cash, accept cash as cash recyclers, all trying to move to an omnichannel payment and lending delivery model. And perhaps what we've seen the fastest growth in the last few years is the shift in how loans are made. And whether we're talking about small businesses or consumers, there's been a marked change in how individuals think about applying for credit. You see advertisements constantly from people. I mean, we'll use, the example you see probably most on the television, Rocket Mortgage, where people can simply go on their mobile phone, apply for a mortgage. It pairs you with lenders or potentially puts it under their own license that they're carrying. And people are simply applying for mortgages from their mobile device, and then everything is handled electronically. They may never actually see another human being until it comes time to close the loan. Student lending has almost fully gone technology driven, where all of your transactions are now being handled remotely. There is no face-to-face interactions with others. More and more credit cards are going fully mobile and online. But then you also have things now where you're seeing a big shift in deposits, where deposits are going online. People are now able to shop nationwide for yield on their deposit accounts, and you're seeing a lot more fluid movement of funds as people go around and shop rates. Perhaps most interesting in the last few years, we've seen what we'd call stacking financial products. If you think about where we're going in the near term, and we'll show you some data about this, perhaps one of the most innovative things we've seen is the idea that a single platform provides all of your financial services. And you'll stack deposit accounts with lending programs, with credit cards, with investment advisory services, and free or no-cost broker-dealer services. So that an individual within one platform can dynamically move funds amongst multiple institutions, multiple custodians, in and out of investment advisory services, broker-dealers, all within one unified platform. So, as we talk, if you think about the last 15 years, we saw a deconstruction of banking where fintech came in and picked off pieces of banking and said, we're going to be a payments company. We're going to be a lending company. We're going to be an online advisory like Robinhood. We're going to be an online broker dealer. Now what you're seeing is actually a reassembly of those pieces back together, but it's being reassembled in the technology sphere, not within the chartered financial institution sphere. And so with these changes comes a series of challenges, but also a series of opportunities for not only large financial institutions, but very small financial institutions as well, who are willing to work within the fintech space to drive deposits, drive lending activity, or drive all, other services that they could offer. A few quotes just to put this in perspective, but if you think about particularly this comment by the chairman of BBVA, many banks, as they look forward, or credit unions or non-bank but licensed lenders, what have you, are saying our competitors are not going to be other banks, other credit unions, other finance companies. What most folks are looking for and saying you will be competing against is the technology platforms. With Apple Pay and Amazon teaming up with various groups, it's going to be more difficult for a financial institution to break into that space. When Amazon does the small business credit line with Goldman, then all of those retailers who are using Amazon to list their products have immediate advertising, easy user experience, seamless transition to get a Goldman business line of credit. And so if your financial institution is doing commercial lending to those clients, it's going to be very hard to break through the wall that's being put up. I mean, I think perhaps most telling is anyone who's following some of the hearings yesterday in the House involving the large technology platform providers. That's one of the things that Congress is hitting upon, is the idea that there's the ability using technology to create electronic walls around certain relationships, and whether that's the relationship with a consumer where he or she is having advertisements directed at him or her, or it's around a small business where data is being sent very easily and there's this integration between the financial services and the small business. It's very easy to put up these electronic walls and make it very difficult to break into that fence or break into that castle that's been put around those consumers or small businesses alternatively. If we look at some of the studies that have come out recently, obviously the big six banks have gotten a jump somewhat on the community bankers. But, interestingly, it's becoming more generationally agnostic. Even a month before COVID, so in January, I was speaking at State Bankers Convention, and I was speaking to largely, in that case, community bankers who were coming and saying, we're still trying to understand what level of technology we need in our platform. Do we really need these fancy ATMs? Do we really need to spend a lot of money on online and mobile banking and some of the products and services associated with it? And what we've seen is the adoption rates are going up dramatically. Millennials are already more than 3/4 are using digital banking as their predominant form of financial services. Gen Xers already up to 70%. And here's, I think, what's most telling in terms of mainline adoption. Baby boomers who, many banks have said are the slowest adopters of technology already, as of this study, half are adopting digital banking as their primary form of interacting with their financial institutions. And so in that regard, we really need to think about how we play into that space. And we've seen this shift occur already. This is some data that TransUnion put together. And if you want to see what fintech does to the landscape, just simply look at this. This is personal loans, so this is perhaps the easiest because it doesn't involve complex securities that are being taken for loans. But when TransUnion deconstructed its data sets to look at over the past, in this case, 7 years, what has been the shift from traditional financial institutions, so banks, credit unions, and finance companies, over to fintech, already fintech, as of the last solid data point, Q4 of 2018, is the most predominant mechanism of an individual obtaining a personal loan. They will likely go to their computer or go to their mobile phone. 38% of individuals will apply for it online using a fintech platform. It's expected to be just below half here in 2019, and then we extrapolated out 2020. And so by 2020, fintech will likely eclipse all other channels as the predominant way in which an individual obtains a personal unsecured loan. As we say, that's probably the easiest in terms of shifting to fintech. You know, when you start talking about mortgages, when you start talking about auto finance, the adoption rates are lower because it tends to be more entrenched. But we've seen the same. I mean, we work with many large automotive captive companies. They're all working towards a digital first platform where individuals will simply apply for financing, go into the dealership, and then pick up the car. Because they know if not, they're losing the customers if they can't provide that type of experience, that type of interaction at the outset, because that's the first point of contact, first point of touch with these particular consumers, is trying to catch them at that very early stage. This is from CB Insights. It's probably one of my favorite graphics I've ever seen, which is if you think about how fintechs are tearing apart traditional banking. This CB Insights took the Wells Fargo homepage and then started deconstructing it and saying what fintechs are doing the various things that Wells Fargo was marketing here. And what you see is hundreds of fintechs that are deconstructing and picking off pieces of traditional banking. Yeah, they're picking up consumer lending. They're picking up student lending. They're picking up investments and advisory services, retirement planning, broker-dealer activities, mortgages, etc. And so if you're, in this case, Wells Fargo, as demonstrated here, you now have hundreds of competitors who are all trying to provide pieces of your service better. And, you know, when we think about this deconstruction, we're now going back into a consolidation phase. You know, one of the things that has tended to protect traditional financial institutions over the last 5 years from the movement of fintech is it was very difficult to create omni-channel. You know, we'll use SoFi as an example. Lots of individuals are going to SoFi to obtain student loans. Great platform for obtaining student loans. SoFi would offer those individual student loans, but then that same individual said, well, now I need a prepaid card, or I need a debit card, or I may need a mortgage. And so SoFi is now, obviously, as you know, the headlines have indicated, exploring broader charter classes. You know, they're trying to move into the mortgage space, really trying to do those wraparound services because they have now all of these, you know, ex-students, former students inside of their platform, and they don't want to lose them to these other fintechs or other banks. And so as each of these companies has been able to pull off and create, quote, walls around consumers or small businesses, they're now trying to do the same things that banks have to do, which is provide multi-channel financial services to keep those individuals within that ecosystem. All of this shifted with COVID, and you know, this is perhaps one of the biggest points we can make today is COVID-19 has effectively accelerated this shift 5 to 10 years. As we see some of this research that Lydeco and FIS has been putting out, you know, in April alone, there was a 200% increase in new mobile banking registrations and 85% increase in mobile banking traffic. Some of the big banks, particularly on days when stimulus checks were coming out, reported their mobile banking systems crashing purely by volume. And so what we've seen is the entire world is now looking towards digital platforms, online and mobile, in order to interact with their financial institutions. And that adoption is across generations, it's across demographic groups. Everyone is moving to online and mobile. You know, if you want to see what effect it's going to have, Novantas did a study, and within their study, approximately 40% of customers have said, even when COVID ends, they don't plan to return to a brick and mortar bank branch after the pandemic. In essence, people have seen how much and how robust the technology is within online and mobile banking. and they're realizing that the need to go to physical branches is falling away, and we expect that to continue. And so when we think about what COVID-19 did, is it forced everybody to non-face-to-face. The entire world has learned about those product offerings that are available, and it's now going to be very hard to go back. So with that, I'll turn it over. We'll talk a little bit about some of the fintech models and what we're seeing within the marketplace.
Great. Thanks, Brad. So this is Brennan, and I wanted to just step back for a little bit and from my prior role within a banking organization, thinking about these fintech partnerships. Obviously, there's a business model concern, a cost concern that banks have before they would pursue partnering up with fintech organizations. And then there's the regulatory risk, which overlies a lot of these issues. When we were looking at a lot of solutions out there, we would make decisions in part based upon limitations within our own core systems that we were operating under and the ability of these fintechs to tie into those. I think a lot of those challenges are getting solved bit by bit. But then the other side of it from the regulatory side was, well, okay, what is the process we have to go through in order to validate and vet these organizations and the systems that we may be tying into? These involve model risk analyses and also vendor due diligence challenges. I think that what we have seen in the recent couple of months is that the regulators are looking at this trend towards fintechs. They're seeing the same data that Brad was just presenting. In our view, they're looking at this as a when, not an if, process in which banks are going to begin to become closer and closer aligned with fintechs, and that line between them will become blurred in the future. So recently, at the end of July the 20th, the FDIC issued a request for information that is, in my view, looking specifically at whether, trying to reduce the costs and risks that banks would face from a regulatory perspective to enter into partnerships with third-party fintech firms. I think the FDIC recognizes that banks need to go down this path, and they're trying to come up with a way to both better regulate it and reduce costs. They specifically note in the release that they are want to look at methodologies to improve their ability to validate the model risk process that banks go through when they evaluate fintechs, and also to try to standardize and reduce the vendor due diligence costs that banks would incur in order to partner up with fintech firms. So I think that we'll see how the comment process goes. Certainly the current FDIC leadership is very focused on this, and I think that this trend will continue. And to the extent that the FDIC can reduce those costs of entry and the risks of entry for banks to partner up with fintechs, it's going to continue to increase the adoption on the part of banks. The other trend that we're seeing, go to the next slide, please. The other trend I think that we're seeing is coming from the OCC side, outside of the supervisory side, is that the OCC has been, and I think we've all seen over the last couple of years, the OCC has looked at different types of charters, and whether we call them payments charters or fintech charters. The OCC is, I think, looking at this and trying to figure out how can they better supervise what they see again as a when, not if trend, in which the lines between fintechs and banks will continue to be blurred, and the OCC wants to ensure that they have the ability to monitor and supervise and regulate these types of organizations. At the end of June, the OCC talked about what they call their Payments Charter 1.0, that they may come out with some better, more details in the fall of 2020. When we talk about these fintech partnerships, and I think Brad and Craig will talk about it in a little bit, clearly one of the reasons that the fintechs are partnering with banks is to avail themselves of the ability to originate loans across the United States without having to comply with individual state-by-state money transmission regulations. And I think that we will, the use of a national charter would help, helps to ensure that is streamlined and handled through one regulator. So we've seen that the OCC is now pushing to try to have a charter that facilitates this. Also note, for those that read The American Banker, in the last 2 days, you've seen some specific resistance, clear resistance on the part of the ICBA and other bank and community bank organizations that are challenging the OCC's plans to go into this space. And I think we will all see ultimately what compromise they work out along the way. But it clearly highlights that the OCC sees this as the trend and the direction that the industry is going in, and they're trying to prompt the discussion and ensure that they're able to regulate within this space. And I think we will see this trend continuing, regardless of whether the charter is actually this fintech charter is actually approved or instituted by the OCC. If it is not, my view is that this is going to continue to still push banks and fintechs together. Next slide. So Square, I think most of the parties again on this call probably have seen that back in March, Square received its ILC charter. That's been a long drawn out process. The whole ILC process since the last financial crisis has been a bit murky as to whether or not it would be reinstituted, but it was notable that in the midst of the COVID shutdown in mid-March of this year, that Square did become the first U.S. fintech to receive conditional approval from the FDIC for its ILC charter. Square has indicated that they would intend to launch the bank at some point next year. You know, there's now a lot of reaction to this. I think as recently as today or yesterday, there was some, again, community ICBA and other bank organizational resistance to these ILC charters and whether or not they've actually called for a 3-year moratorium on any new ones. I think they clearly view the Square charter as a direct threat to the banking industry. Again, I think that recognizes the fact that the charter was granted, recognizes the FDIC's view that, hey, the lines are getting blurred between fintechs and banks, and we're ultimately going to go in this direction. So why are we continuing to resist it? We will again see whether that moratorium becomes a reality or not. But again, I think as we see the trends going in this direction, we will continue to see this blurring of the lines between fintechs and banks. So, this just sums up on this slide some of what we've just talked about. I think as we look at this, we view as a law firm that this is the trend that banks will continue to go in. Regulators are creating more clarity for banks to partner with fintechs. The FDIC in particular does have a number of teams that they are training to be specialized in evaluating these fintech relationships and better understanding the models and the model risk analyses that comes from some of these AI and other automated solutions. So with that, I'll let Craig talk about and Brad talk about further developments in the area.
Yeah, and that's a great point, Brennan, because I think one of the things that is perhaps most interesting is actually this quote that Comptroller Curry had made during a House Financial Services Committee, which is, starting in 2016, maybe 2015, a lot of fintechs decided they wanted to become banks. And there's a big push towards having this national charter available, working towards a payments charter, or alternatively even a industrial loan charter that would allow you to do multi-state preemption lending. And then a lot of the fintechs looked and said, well, wait a minute, with banking comes a lot of other obligations, CRA, community development, accountability, safety and soundness, what have you, that are all associated with chartered financial institutions. And so if we're reading between the lines here, it appears that both the OCC and the FDIC have said there is a play for traditional banks and credit unions with NCUA in order to come into this space and partner with fintechs. And rather than ceding the space and allowing the fintechs to take control of this ecosystem, there's a pretty good play for banks that are willing to work with them. And you constantly see in American Banker and other publications stories about these banks with dramatic growth because they're working with fintech companies through these partnerships. And I think the regulators are looking and saying, look, this isn't an us or them analysis. There is a third way where we work together and the banks provide back end in a highly regulated, highly accountable way, under supervision of its prudential regulators. But then also you have the technology infrastructure, the user experiences that can only come from the technology side of the world. And, natural offshoot, obviously, of that is then when we start looking at how are banks looking at true fintech partnerships and collaborations. And every year this number goes up, but 49% of banks, 60% of credit unions say fintech partnerships are going to be key to the growth of their institution. This study that Cornerstone conducted, and every year this number is increasing, because what we're seeing is, if we kind of take the two pieces together, you see a loss in market share, and now here's the result of that, which is how are we going to get back in the game as chartered financial institutions. But if anything, COVID not only has accelerated the adoption of fintech, but it's also shown fintechs the cost of having to run multi-state platforms. I mean, if you think about a payments company, and if you were to go out and say, I would like to start a payments company where I can accept money and send it to someone else, acceptance of money, transmission to a third party, you're looking at 49 different state licenses, 49 different examinations, huge compliance infrastructure that's going to be required just simply to keep up the license classes. And that's not including if you also want to make loans, where now you're talking 50 different licenses to make loans in the various states, or registrations in order to make loans. And so if you're a fintech company and you say, we want to provide bank-like services where we're going to make loans, we're going to accept funds, we're going to have a payment system that's going to transmit money to third parties, you're talking right there 99 different licenses at a minimum in order to do a nationwide footprint. And so the fintechs are saying, well, wait a minute, I want to expand nationwide. I don't want to be a Georgia payments company or a California finance lender. I want to be able to go nationwide. And what they're saying is the cost of that can go into the millions of dollars and take years to implement that type of strategy. I mean, even on the payment side, I mean, unless you're someone like Western Union, MoneyGram, ACI, you're probably not carrying 49 money transmission licenses. And so what they're saying is, well, wait a minute, there's these things, these banks and credit unions that can do exactly that. How can we share by reducing our compliance and regulatory costs within this highly regulated space, find people with risk management experience, BSA AML expertise, et cetera, while bringing the best of fintech world to bear, innovation, user experience, the ability to set up these clean, simple interactions with customers, and the ability to wall them and drive them into financial products. And so I think the fintechs look at this as well as saying, unless you're the size of Square or SoFi or PayPal or others, it may not make sense for you to get your own charter. If instead you're a company that's, is a growth fintech, your best bet is likely to partner with a chartered financial institution. And when we think about the financial institution side, there's a broad array of what we mean when we talk about bank fintech partnerships. It's not simply lending or payment processing. I mean, it can be financial management. You could have, we work with a number of banks who specialize in particular industries. Maybe they work with homeowners associations for payment processing and collections. We have others that are very industry specific. They may work with money services businesses in a given state. We have one socially responsible bank where their focus tends to be working with mission aligned partners who share their social goals with them. Many banks have gotten already into the card processing, ATM acquiring space. But all of these are different ways to think about bank fintech opportunities. And it may be that your institution is not doing this now. And the question is, would you be interested in doing it if it meant you could keep your customers, grow your customer base, as well as generate non-interest revenue? Brennan and Craig and I were talking yesterday, and Brennan made a really great point, which is as the credit markets continue to tighten, the ability of an institution to earn revenue off of the interest is becoming increasingly more difficult, particularly if we go into a significant default cycle in the near term. That said, for instance, in the payment space, somewhere between 2.85 and 6% of payments are going in the way of fees to somebody, some institution. And the more your institution is willing to play in that space, the more of that share you're able to acquire. Similarly with lending, if we know that 55% of personal loans are now being made by fintech companies, that's a huge market share. If your bank or credit union is willing to participate in, then you can pick up some of that market share. And rather than your customers going on to lendingtree.com and shopping for the lowest provider, you might actually be getting leads from lendingtree.com. Or maybe you're integrating with a fintech so that you're out there affirmatively marketing your personal loan product to your customer base. All different ways to think about how this model can work. The other thing I really want to drive home, and was presenting it last week to another industry group, and what I wanted to really make is a great point that one of the co-presenters made. When we talk about bank fintech partnerships, it doesn't have to be the spaghetti diagram on the right. This actually comes from a deal where we just finished that involves banking as a service, where the bank is actually working with the fintech, is somewhat white labeling a financial product. Bank is making the loans and is then stripping it into a participation where we're going to have a derivative payment stream that's split to an investor group, so it cleans up the bank's balance sheet. All very complex, really great in terms of the way the bank can deploy those funds, but it doesn't have to be that complex. It could simply be something as simple as working with fintech companies to market your bank or credit union, working with that fintech company to drive referrals to your institution, so that consumers or small businesses are aware of your products and you're able to capture market share without having to organically, through significant cost of acquisition, send out loan officers, marketing pieces, et cetera, to drive your own adoption. During that presentation last week, one of the big fintech companies that does lending said, with a mobile customer, their cost of acquisition for a given loan is below 20 cents. For an online customer, it's below 40 cents. If you are doing brick and mortar and you are making loans through brick and mortar branches, your cost of acquisition all in is probably $100 plus per loan. And you see similar disparities when you talk about the cost of opening a new deposit account. We joke that we have worked with a number of banks who've gotten into the payment processing space, or what we call banking as a service. And one in particular, they were opening maybe 5,000 new accounts per year. They partner with a large fintech, built a really phenomenal platform, and in the first week they opened 10,000 accounts and have maintained that volume consistently thereafter. And so you just see these dramatic numbers where you're going to have 100x increase in the number of accounts. You may have 25, 35% year-over-year deposit growth because of these relationships. We talk about those models, there really is a significant spectrum where you can play in this space. It could be something as simple as referrals all the way up to investing in fintechs, working on private label solutions, where you're going out and the fintech is actually integrating into your bank's existing systems to make it better. We'll talk in a minute about some of the AI lending that we're seeing that's become a hot button issue for the FDIC and the OCC. And maybe it's bank-to-bank referral arrangements where you're trading deposits between a high-tech and a low-tech bank. Maybe you're going to start outsourcing processes. You need to find the ability to underwrite to that next FICO group below your traditional core matrix. And you're going to outsource to some of these underwriting engines that will probably do it better than your credit team ever could using big data. And then obviously at the end, we go into full bank model partnerships where the bank is really acting symbiotically with the fintech company. And you see a spectrum even within that where some banks are marketing themselves as banking as a service, or BaaS, where a fintech can come to them. They are platform agnostic. You've seen some of the really fintech-driven banks that are out there. A few come to mind. Probably one of the best is Cross River Bank out of New Jersey has a phenomenal platform that fintechs can build upon, and they're able to then integrate very seamlessly within a very controlled environment with significant data security controls and the regulatory infrastructure of Cross River Bank running behind it. So a really neat platform that those guys have built with that bank. And you see a huge influx in of fintechs who are going there because they like that certainty that this is an experienced bank who knows how to do it. And so, you know, it doesn't mean necessarily you have to go all the way that deep into bank fintech partnerships, but you could. To support that now, we're seeing the regulators coming in and trying to help the banks. OCC just last week, great piece that they came out with. One of the things that you run into with bank model lending is a number of states are pushing back on this. If you think about a state like New York, for instance, has a 21% usury rate, civil usury rate. And because of bank preemption, historically, a credit card bank or a lending bank could go into New York and simply ignore that 21% usury cap for consumer loans because of their banking charter. Well, then fintechs came into banks and said, okay, bank, you make the loan and you either sell me the loan after you make it, or we do one of these derivatives where we split the loan and the payments in order to gain a little bit of additional protection. And the states didn't like that these fintechs were able to avoid getting state licensed charters, and they were trying to attack this model through what's called true lender attacks, where they're saying, you know, ha ha ha, Bank ABC, you're not the actual lender. It's actually this fintech sitting behind you. OCC has started to push back to help the banks, you know, and the fintechs in turn, and actually have come out with proposed rulemaking to adopt what's referred to as valid when made, meaning the test of when a loan is made by a bank is going to be set forth in rulemaking by the OCC. And in essence, it's going to protect these types of models where the bank initially funds the loan, signs the paper with the customer, engages in the loan, underwrites it, but then the bank may derivatively sell it in order to regain part of its money, and it may be selling to a fintech as part of that. And so, you know, something that is, you know, hugely contentious, but is going to significantly change how we think about the industry. And I think part of this goes back to what Brennan was mentioning, which is as the OCC is looking at this, they're saying, wait a minute, we want to keep a role for our banks. You know, if not, we've got to go the charter route and start chartering these fintechs. And that's probably not the right fit. Instead, let's use our existing banking infrastructure in a highly regulated way and have them partner with the banks to offer these types of financial products. So, yeah, I think we're starting to see a lot of regulatory support for a lot of these models. And, you know, nice segue there. You like that? We'll turn it over now to Craig, who's going to talk about a number of those regulatory concerns.
Thanks, Brad. So we want to start off with the regulatory concerns of how a regulator is going to view your partnership with a fintech, no matter where it is on the scale that Brad was talking about earlier, or the spectrum of the fintech solutions or fintech partners that are out there. So if you're a fintech, you want to partner with a bank that has a robust third-party oversight program. It might seem counterintuitive at the beginning, given the fact that it's going to generate a little bit more work. If you're within a fintech and not used to the regulatory oversight and regulatory burdens that the financial services industry has, it seems very a lot of work to go through this diligence process the first time when working with your first bank partner. But you don't want to partner with a bank that has, you know, minimal standards out there. You want a partner that's going to be in it for the longevity of it. You want somebody that a regulator is not going to come in and say, you know, you don't have the subject matter expertise, you don't have the proper controls over the fintech partner, so you're going to have to exit this segment as soon as possible, just from a safety and soundness perspective. And you do see smaller banks with very little oversight getting hammered by the regulators on these points, where you see banks that are more involved in the fintech spaces with very robust compliance programs, a lot of controls in place, allowed to run these programs at length with no interference from the regulator. If you're a bank, you can view these fintech partnerships as a way to consolidate operational functions, offer new products, improve customer experience, deploy new technologies, or even to deploy stronger compliance controls like BSA AML, or we're going to talk a little bit about fair lending in a few minutes. But what you can't do as the bank is view the partnership as absolving you of any required oversight. As I was saying at the start, the oversight is very important to the regulators. It should be very important to your compliance management system as a whole. So when you're even looking to enter into your first few fintech partnerships, or outsource small operational procedures that may gain the efficiencies you're looking for going through the rest of 2020 or into 2021, you want to review all the associated compliance controls within the partner or within the fintech. Depending on what the solution is going to dictate how in-depth those reviews are. But you want to make sure that you have a full understanding of the compliance controls that are deployed within the fintech, and that expertise lives within the bank somewhere as well. You don't want a regulator coming in asking you, well, I see you outsource a lot of your BSA controls to this fintech, and they might be top-notch with the partner you chose. But if someone within the organization can't explain what they're looking for within that BSA technology solution or whatever the partnership is, the regulator is going to see an outsized risk there. You're also going to want to document applicable controls and oversight with a master services agreement. You want to make sure that the controls and the functions that you have in place are documented and formalized for a regulator, that show what your requirements are, what your abilities are with the partner, to check in on them, make sure that they're living up to the compliance requirements that you as a bank are held to, and the standards you are held to. And when you formulate that and you formalize that within an MSA, make sure internally that you're actually equipped to do that. You don't want to outline something within an MSA that puts a burden on you as a bank for an oversight that you're just not going to do. It's not a check-the-box kind of exercise here. The regulator is going to want to see how you are actually walking through that life cycle. They want to see how you're vetting this vendor at onboarding, and again, annually or semi-annually. You want to determine the regulatory, reputation, and litigational risk associated with the fintech partner's operations. You want to make sure that if the risk is outsized, how you're going to manage that. And that speaks to that last bullet point there. You want to monitor the partner on a schedule applicable to the presented risk. Meaning, if you're partnering in a space, say prepaid cards that are not only domestic but international cards, or money transmission internationally, that's going to present an outsourced risk for your BSA compliance department. You just can't partner with or run a program in that space without having the internal controls or the internal expertise within the bank. You want to show the regulator that you're equipped to manage those risks, those outside risks, and have dedicated substantial resources to managing it as well. Next slide.
And Craig, it's Brennan, if I could just add one thing to it. Having been in the bank space and gone through regulatory exams in connection with these areas, one of the things that we've done to work with some clients as a law firm in the past is help to document and analyze the controls process and the analysis process around these types of partnerships, and ensured that documentation is shared with a broad enough group so that when the regulators come in, it's very clear amongst the risk and compliance group and senior management that they understand the relationship, and when the regulators ask questions, they know how to answer them because it's been documented, it's been outlined, and everybody speaks from the same page and has a common understanding of it. An area where you run into failures and real challenges with your regulators is that if you have a siloed understanding of this, and in your exam you have personnel that are interacting with the regulators who don't really understand it and don't know how to explain it, it's just going to go downhill from there.
Great point, Brennan. Moving on. Okay, so here we have the OCC semi-annual risk perspective. We want to kind of showcase the dual narratives that you're seeing from the regulators. Here in these two boxes, you're seeing the OCC from a risk perspective raise issues that they have with the use of third parties inside the bank. And then the second dialog box there, specific to their concerns around AI and machine learning. We'd like you to understand or take away from this presentation that while the regulators have all independently put out statements in support of disruption and the use of partnerships and fintech solutions creating more robust compliance solutions all the way to more responsible lending. At the same time, you're also hearing the narrative that's not touted in the financial services press a lot, but they are very aware of the risks that these partnerships create, and because you're reading all the narrative from the regulators that they're behind these innovations, you also want to make sure that you're understanding that they're also checking on the compliance controls that are associated with the innovation. In that first dialog box there, the underlined section, the OCC is pointing out to a key driver of risk is the increasing use of third parties to provide and support operations that are not effectively understood, implemented, and controlled. They're basically saying here that you may be outsourcing an operational function or bringing in a product that is a good thing for your operation, a good thing for your institution, but you want to make sure that you understand it internally, that you put controls around it, and you have the subject matter expertise there within the bank to manage it. That second dialog box, they're speaking specifically to AI and machine learning. I'm going to use that as an example in the next few slides as to how the regulators are viewing artificial intelligence and machine learning within credit underwriting, and what the compliance challenges that we see there are as well. Next slide, Brad.
Before you go to that, though, I think that's a great point you just made, which is, yeah, we've heard horror stories about banks running into trouble with fintech partnerships, and it's very agnostic to the size of the bank. Instead, what regulators are looking at is the expertise that your bank has in terms of the SMEs that are within your institution to manage that relationship. And so, yes, you may be, there's a famous example of a bunch of Google execs who purchased a one-branch bank that's moving huge volumes of payments. And they have one branch and maybe 8 branch employees, but they have a massive BSA AML compliance department that's working as, in essence, a payment processing bank. And there, the regulators can see that subject matter expertise because it's kind of agnostic to what your traditional bank profile would be. And making sure you have that subject matter expertise is really the key to making these successful. Thanks, Craig.
Exactly. Great point, Brad. It's not so much that you're looking at it as a risky space to play in, but a regulator will be okay with you, wading into those waters so long as you can competently explain the risk there and how you're managing those risks. Next slide. So as I said, we're going to start to use alternative underwriting data as well as AI, machine learning as an example of how the regulators are viewing these developments within fair lending, through a fair lending lens and also through a credit underwriting lens. So alternative data basically is anything beyond traditional credit reports. So we see here some examples as to what can be used, anything from current job and income data all the way down to like cable TV payment history, prepaid card spending, anything that you traditionally wouldn't consider in your normal underwriting processes. How are you going to weight those and use those in your credit models? Next slide, Brian. So why use these alternative data? Here we have an article from Forbes from April 21st, 2015 as to why banks would want to use this alternative data and how it's going to increase your borrowing population. Basically starting with millennials are not using traditional credit and credit cards, so they're not going to have the same credit history as the older generations would have. And that lenders are now focusing more on cash flows rather than credit scores. And all the way down to data shows that other information is more predictive than credit scores themselves, and you can get a better risk model for your bank depending on how much data you use, including alternative data. You'd like to compare and contrast that with what the CFPB is saying. The CFPB is looking at it from not just increasing your how deep of credit you're going to buy, or getting outside of your traditional FICO scores, but also who's that serving. They like to point out that 26 million Americans are credit invisible. That 1 out of 10 adults have no credit history. So they look at this as opening up credit options for an underserved population of borrowers, specifically in protected classes. The number of Americans that are credit invisible skews against Black consumers, Hispanic consumers, and various consumers in low-income neighborhoods. So the CFPB views this as net positive when you deploy alternative data in your underwriting model. Next slide, Brad. We also have an interagency statement on the use of alternative data, which came out late last year. So they're saying that it may improve the speed and accuracy of credit decisions and help banks evaluate creditworthiness of consumers who are currently not able to obtain the credit. But they also want to point out the compliance functions. Like if you look at that last bullet point there, robust compliance management includes appropriate testing, monitoring, and controls to ensure consumer protection risks are understood and addressed. They're talking about within the institution or within the non-bank lender themselves. This, again, is a great example of the dual narrative that we're seeing from the regulators. You start to see them lead with, hey, this is a great thing for certain underserved communities. It's a great thing for the borrowing population in general. We might be able to get more people into the banking system. The unbanked will have greater abilities to leverage these various products. But they always close with, by the way, it's great, but make sure that your compliance management system is up to par and that you have the subject matter expertise within your institution or within your non-bank lender there to understand the risks that are presented. So we want to talk about a little bit about the risk there now, again, using the AI and alternative data and machine learning. So next slide, Brad. So fair lending risk, it's an obvious one in alternative data. So here we have just a little bit of a flow chart. The risk will vary with the type of alternative data you're considering, but again, this is a point where you're going to have this expertise in-house. Do you have somebody, or is your fair lending department have the ability to contemplate how that risk shifts with what data points you're using? Have you utilized the proper studies or seen the impact, or are you testing for the disparate impact amongst your credit portfolios when you deploy these alternative data metrics? What you don't want to see is, a fair lending group that's been stagnant for the last 20, 30 years and is under a management team that's like looking for the next best thing. So we're going to outsource or partner up with a fintech that allows us to use alternative underwriting and alternative data points. And then when the regulator comes in and asks the fair lending department about this, it's all pointing to the vendor. Here's the perfect example as to why you need the expertise in-house. You need to make sure that the partner that you're picking is deploying metrics and looking for statistical anomalies that are going to point out to any disparate impact that is possibly in your credit portfolio as you start to deploy these alternative data metrics. Next slide, Ron. Here you see some abuses, fair lending abuses in alternative data. We've highlighted some different alternative data metrics that are used as a proxy for protected classes. The schools attended for an individual. We were talking about the Sally Mae case here. Targeted marketing is a big one. A lot of Facebook cases. You'll see this. You see a lot in your recontact marketing or your online marketing firms. A lot of the clients we have within institutions will, look to grow through online or digital marketing and not really have the subject matter expertise internally to kind of connect the dots there to see what that will create downstream. So in this case, in this bullet point, we're talking about targeted marketing through Facebook ads. So you'll see Facebook offering filters who can see the ad with categories such as women in the workforce, moms of kids, foreigners, Puerto Rico Islanders, all which suggest various protected classes. And if you're not aware of what your marketing partner is doing or who's seeing these ads, you'll unfortunately learn about it when you have regression testing done by your regulator, and that's the last case you want to be. You want to be able to show that you vetted the fintech partner or vetted the marketing partner in a way that shows you were aware of the possible downside risks. As long as you're showing you were aware of those risks and that you were putting controls and trying to combat them as best you could up front, the regulator is way more forgiving if there is a finding of disparate impact. And it's much easier to argue against the finding of pattern and practice if you have the controls in place when you're onboarding like a targeted marketing firm or a targeted marketing fintech. There's other issues here too that we've highlighted. Geographic location, length of residence, high mileage vehicles, all have shown to be possible proxies for fair lending issues within alternative data. So you want to be aware of all of those as you're rolling these out or looking to partner with various fintechs. Next slide, Brad. Here we just want to showcase the fair lending risk and how they increase depending on what you're doing. Again, this expertise should be internal, but you want to have basic understanding that non-traditional credits such as payday and title loan payments, consumer installment loans, rent-to-own payment history is less of a fair lending risk than, say, at the other end of the spectrum, your social media, like we were talking about earlier, affiliation with existing customers, data provided in online profiles, information on uses of friend network. those can all very easily or quickly find themselves on a slippery slope towards proxies that will show a disparate impact to protected classes. Next slide, Brett. So when you're looking to partner with a fintech or innovate within the financial services industries, we want to highlight these two resources for you. The OCC has an Office of Innovation, which has been around now for a little more than 3 years. It puts a framework out there supporting what responsible innovation looks like, and they have various publications posted on that website of Office of Innovation that you can look to build out your regulatory framework, your internal CMS, when you're looking to innovate within various spaces. We also have the FFIEC's e-banking booklet. This provides guidance to examiners on financial institutions on how to control the risks associated with electronic banking activities, a lot of activities that you would be outsourcing to fintech. It's a great place to start if you're looking to partner with various entities out there that are providing digital solutions or electronic solutions to various operational procedures that you have. We always think that the best way to start to look at your compliance controls is kind of reverse engineer it, look at what the examiners are looking at, and build your program backwards. And this is a great start if you're just starting to go into fintech partners. A great place to start would be to look at what the examiners are going to be reviewing you on in the next 12, 24 months after you deploy something like that. Next slide, Brennan. The CFPB, as you get bigger and you come under the CFPB regulations, or if you're a fintech or a non-bank lender and you're already under CFPB supervision, a great thing that they've rolled out over the last couple of years is their various sandboxes. They have 3 different sandboxes for fintech and for innovation. They have a compliance assistance sandbox, a trial disclosure sandbox if you're looking to kind of shake up the way you're deploying your disclosures or new disclosure sets, and a pitch a pilot program where you can come in there and actually pitch the CFPB your take on how you can innovate within various verticals within financial services. All of these have been moving along slowly but surely. You see them more on the fintech side, or more being utilized more on the fintech side than the banking side. But it's a great way to kind of get your feet wet and understanding what's going on out there. You should be tracking all of these sandbox initiatives and any no action letters. We're going to go over one of them shortly, but it's a good way to start to see where the CFPB concerns are. And if you understand what the CFPB is looking at from a regulatory perspective, you can kind of just extrapolate what the FDIC or the Federal Reserve is going to do when they come in there if you're in similar situation or similar partnerships. Next slide, Brett. So UPSTART, they were issued a no action letter in 2017, UPSTART Network Inc. Here, UPSTART was saying if an applicant had no credit score, the applicant must have graduated from or be enrolled in a bachelor's degree program, a more advanced degree program, or an associate's degree program, or a job offer or verifiable solution of income. The CFPB staff stated at the time it had no present intent to recommend initiation of supervisory or enforcement action against UPSTART with respect to any possible ACOA violations. They went in for a no action letter and were working with the CFPB in one of the sandboxes to see how their alternative underwriting would play out under ACOA and how, if it would create any possible violations if it was utilized outside of the sandbox and deployed widely through various institutions. Next slide, Rob. So then as an update, in August 6, 2019, we actually got some good news back from the CFPB that the alternative data being used by UPSTART in their underwriting model approved 27% more applicants than the traditional credit score-based model and yielded 16% lower average APRs for approved loans. We also saw applicants under 25 years of age are 32% more likely to be approved with this data set that UPSTART was deploying. And consumers with incomes under $50,000 was 13% more likely to be approved. So this is all kind of data that the CFPB likes to see, and it kind of proves their model that that disruption or innovation within alternative data or in credit underwriting models can be responsibly developed and deployed with positive impacts to those that the CFPB is literally built to protect. They also would love to point out that there was no observable disparate impact on minorities, females, or individuals 62 and over. This is a big deal to see how the alternative data was being deployed. And with metrics like this coming back, you're going to start to see this being utilized more and more as you go further into 2020 and 2021, this will be a large deployment across various credit underwriting models. Next slide, Brad.
And Craig, we did have a question coming. I think it's a good one, which is, when a bank is thinking about targeted outreach, is it possible to still do targeted outreach without running afoul of some of these fair lending concerns? And I think that's a good question, and a lot of it's going to depend on what the actual messaging is. But certainly, I think it's appropriate, with the right controls in place, to use social media because of its predominance, particularly if you're trying to reach out to certain groups in order to target certain groups to make them aware of your financial products. Now, that kind of assumes that you're not, offering divergent financial products, and that you're not going to run into some redlining issues there. But certainly in the same way that a lot of banks will work with advertisers that focus on traditionally underserved communities, or work with partners in those traditionally underserved communities in order to make sure that those groups are aware of the financial products that the bank is offering. I think that's absolutely fine on Facebook or other social media platforms. Like I say, you've got to be very careful, though, particularly, though, because given the specificity with which you can do some of these targeted marketing, like we said with Facebook. I mean, there's even categories you could check that say, you only want to target individuals who have written posts about hijabs. And specifically targeting individuals who practice the Muslim faith. And so then in those circumstances, you've got to be extremely careful with the messaging as well as the product offerings to ensure that you're not going to run into a fair lending risk. But I think at the same time, it can be very beneficial as a way to reach out to some traditionally underserved communities.
Yeah, I totally agree. I always look at it where if you're going to deploy or if you're wading into the targeted marketing waters, you kind of want to, again, reverse engineer it. Think about in a year from now, if the CFPB or, whoever your regulator is, if it's the FRB or the FDIC is on site, or the OCC is on site, and they're asking you about disparate outcomes within your regression testing, you want to point, and they say, hey, you deployed targeted marketing, is this driving this? You want to be able to say, well, we thought about that beforehand. You don't have to be right. There could be a disparate impact at the end result, like that you were unaware of. But you want to be able to show the regulator that you responsibly used the targeting marketing, that you were aware that there was some fair lending issues and fair lending concerns present when you decided to utilize this partner or onboard a fintech or partner with a fintech in this targeting marketing space. You want to be able to say you ran that through your fair lending group. It was reviewed for any disparate impact or possible ACOA issues, and it could be that none was determined. That's fine. If you believe there was not going to have a disparate impact outcome, and it happened to when you start to look at the regression testing 6 or 12 months later, you just go back in and tinker with who you were targeting. Obviously, it can't be discriminatory on its face. Like, you can't exclude certain zip codes, or you can't exclude various groups that are protected. But like, you may be, completely well-intentioned, and if you cannot prove that you did not consider or weigh those fair lending issues when you deployed this action, whatever regulator you're in front of is going to look at that as an outsized risk. They're going to look at that as your CMS failing to account for the possible risk at the upfront and protect the consumer from possible harm upfront when you engage the particular fintech or targeted marketing partner. Whereas you could have just run it through your fair lending group and been aware of the risk and had the same exact outcome, but you might not get an MRA that way, if that answers your question. Finally, the slide up here, we also would just want to close with the note that the fintech sandbox is just on the federal level with the CFPB. You're seeing in a variety of states. Here we highlighted 3 of them. Certain states have way more activity than others. It is good too if you're looking from the banking side, if you're looking to step into the fintech partnership or see different solutions that are out there deploying different technologies. It's good to see who's applied in these various states and see what kind of solutions or fintechs are being deployed within these states. And that too, again, even if you're just doing that on a primary entry level, just that research alone, you're going to want to show to your regulators. You're going to want to show that you contemplated, what are these fintechs doing out there? It's kind of your due diligence as we opened up the regulatory concerns section. Looking to see if there are peers of the fintechs that you're partnering with in other states that may be doing the same thing or kind of deploying the same solution. And you're looking to see if that's created any issues or if any various state regulators had concerns with this particular solution. So it is good to check on all of those. If you're this fintech and listening, if you're one of the fintechs that are listening to this, you also want to see what states are out there to see what you can do. Go as far as you can without the regulatory scrutiny that you might get without applying for one of these sandbox permits. And I think that wraps things up, Brad, unless you have any other questions.
No, if anyone has any questions, feel free to send those in. I want to thank you for joining us today. Just like all of our In the Trenches series, this one will be archived as well. You're free to use it for internal training or if it can be of any assistance. This recording will be part of our YouTube feed with all of these recordings for the In the Trenches series that are available. I think we're up to 20 some odd now. Should you have any questions, follow-up, feel free to reach out to any of us at the banking team at Nelson Mullins. We're obviously something that we're very passionate about is working with financial institutions on these fintech partnerships, as well as working with the hundreds of fintechs the firm works with, finding them the right partners as they continue to expand. So with that, we'll close out today. Thank you so much for your attendance, and we look forward to seeing you next week as we continue within the trenches. Have a great afternoon on the East Coast or a great rest of the morning on the West Coast.
Thanks, guys.
Thanks.